Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.20 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover three main ideas: what execution slippage is and why it matters, what a requote looks like and how it can affect your trade, and a quick look at real-world examples that show both concepts in action. By the end of this video, you will understand how a tiny difference between the price you expect and the price you actually get can change your profit. And you'll know exactly what to do the moment a broker asks you to confirm a new price. Think of it like ordering a pizza for delivery. You expect it to arrive at 6 p.m., but traffic can make it show up at 6:10 p.m., and sometimes the restaurant might say, "Sorry, we're out of pepperoni. Can you accept a different topping?" That second situation is similar to a requote. We'll walk through a live euro to US dollar news spike that caused a few pips of slippage, and a fast-moving pound sterling to Japanese yen quote that turned into a requote. I'll also point out why beginners often ignore these tiny details and end up surprised at the bottom line. So grab a notebook, because we're about to demystify two hidden costs that every trader, even algorithmic ones, must plan for. Let's get into it. Let's start by defining execution slippage. In plain language, slippage is the difference between the price you intended to trade at and the price you actually receive when the order is filled. Imagine you are at a grocery store. You see a sign that says apples are $1 each. You grab one, but when you get to the checkout, the cashier tells you the price has risen to $1.05 because the store just ran out of the discount. In Forex, the market moves so fast that the price you see on your screen can change in the split second it travels to your broker's server. That change is slippage. Why does it matter? Because even a few pips, those tiny units of price movement, can turn a winning trade into a break-even or losing one, especially when you trade with tight stop losses or small account sizes. For example, during the European Central Bank rate decision, the euro to US dollar pair jumped from 1.0998 to 1.1015 in less than a second. A trader who placed a market order at the displayed price of 1.1000 might have been filled at 1.1007, resulting in a 7-pip slippage. If that trader had set a stop loss only 5 pips away, the trade would have been stopped out immediately, wiping out the intended profit. Slippage is especially common during high-impact news, low liquidity times, or when using brokers with slower execution speeds. Understanding it helps you set realistic expectations, choose appropriate stop-loss distances, and select brokers with low latency. In short, slippage is a hidden cost of speed, and recognizing it early protects your capital from surprise losses. Now let's talk about requotes, another subtle but important concept. A requote occurs when you send an order to your broker, but before the trade can be executed, the broker's price has changed, so the platform asks you to confirm a new price. Think of it like calling a rideshare. You request a ride at $10, but while the driver is on the way, traffic builds up, and the app updates the fare to $12, asking you to accept the new amount. In Forex, a requote typically appears during very fast market moves or when the broker's server is busy. The impact can be significant because you may end up entering at a worse price than you planned, or you might decide not to trade at all, missing the opportunity. A concrete example: during a surprise Bank of England announcement, the pound sterling to Japanese yen pair surged from 152.70 to 152.90 in a matter of seconds. A trader placed a limit order at 152.80, but the broker's system could only offer a new price of 152.85 when the order reached the server. The platform displayed a requote pop-up. Price changed. Accept 152.85? If the trader accepted, the trade opened 5 pips higher than intended, reducing potential profit. If they declined, the trade never executed, and the price continued to climb, leaving a missed chance. Requotes are more common with brokers that use market maker models or have higher latency, and they are especially prevalent on exotic pairs like pound sterling to Japanese yen, where liquidity can thin out quickly. For beginners, the mistake is to ignore the requote window or assume the original price will always hold. The key is to stay aware, decide in advance whether you will accept a small price change, and factor that possible extra cost into your risk management plan. By treating requotes as a normal part of the trading process, you avoid surprise losses and keep your strategy realistic. All right, looters, let's dive into a real-world example of execution slippage using the most traded pair in the world, euro to US dollar. Imagine you are watching the market on a Friday afternoon, and a big economic report, say the U.S. non-farm payrolls, is about to be released at 9:30 Greenwich Mean Time. You have set a buy order at 1.1000 because you expect the euro to rise after the data. In our chart, you can see a green candle leading up to the news, showing a calm market. Then the news drops, and the market reacts instantly. The price drops sharply, forming a tall red candle that moves the rate down to 1.0992 within seconds. Because the market moved faster than your order could reach the server, your broker filled the trade at 1.0992 instead of your intended 1.1000. That difference of 8 pips is called slippage. Think of it like ordering a pizza for delivery at 6 p.m., but the driver gets stuck in traffic and arrives at 6:15 p.m. Your dinner is late, and you might have to eat something else. In trading, slippage can turn a potentially profitable trade into a small loss, especially if it happens repeatedly. It matters because every pip counts in Forex, and the more volatile the news, the larger the potential gap. By watching the chart, you can see exactly where the intended entry was marked in white and where the actual fill occurred, highlighted with a dashed arrow. This visual helps you understand that slippage is not a mystery. It's a mechanical result of price moving faster than your order can be executed. Recognizing this helps you plan for it, perhaps by widening your stop loss a bit or avoiding trading right at major news releases. Now let's look at a different but equally important phenomenon called a requote, using the pound sterling to Japanese yen pair as our example. Picture this. You're watching a fast-moving market where the British pound is suddenly gaining strength against the Japanese yen. On the chart, you see a series of calm green candles, then a tall green candle that shoots the price from 154.90 up to 155.20 in just a few seconds. You have placed a pending buy order at 155.00, hoping to catch the upward move. As soon as the price hits your level, your broker tries to fill the order, but the market is moving faster than the broker's server can respond. Instead of confirming the trade 155.00, the broker sends you a pop-up that says, Requote, new price 155.45. This is a requote, essentially the broker saying, I can't give you the price you asked for. The market has moved. Here's the new price. Think of it like standing in line at a coffee shop, ordering a latte for $4, and the barista says, sorry, the price just changed to $4.20 because the beans cost more today. In trading, that extra 45 pips can make a big difference to your risk and profit potential, especially for a pair like pound sterling to Japanese yen, where each pip is worth more than on a euro to US dollar trade. The chart marks the original pending order price in white, then shows the requote price with another white label, linked by a dashed line to a red pop-up that mimics what you would see on your screen. By visualizing this, you see that a requote is not a glitch. It's the market's way of telling you it moved too quickly for the original price to be honored. Understanding requotes helps you decide whether to accept the new price, cancel the trade, or adjust your strategy, especially during fast moves. Finally, let's explore why many beginners tend to underestimate both slippage and requotes. Picture a new driver who assumes every road will be completely clear, never expecting traffic lights or potholes. In trading, a beginner often imagines that every order will be filled exactly at the price they set, like a perfectly timed stop loss at 1.2500 on euro to US dollar. The left side of our diagram shows that ideal world, a calm green candle, a white label saying expected fill at 1.2500, and no signs of delay. But the real world is more like the right side of the diagram. Here you see a sudden red candle spike, indicating fast price movement, and 2 white labels, one for the intended entry at 1.2500 and another for the actual fill at 1.2485, connected by a dashed arrow to illustrate an 8-pip slippage. Above it you notice a small red clock icon labeled broker latency, which reminds us that the time it takes for your order to travel from your computer to the broker's server can add milliseconds. And in a volatile market, those milliseconds can mean several pips. Next to it is a yellow exclamation mark labeled unrealistic stop loss, highlighting the mistake of setting a stop loss only a few pips away from the entry. When a market gaps, that tiny buffer disappears, and the stop loss may never trigger, or it may be filled at a worse price. Requotes appear in the same way. The broker tries to give you the price you asked for, but the market has already moved, so you get a new price request. Beginners often ignore these realities because they focus on the theory of perfect execution rather than the mechanical limits of technology and market speed. By visualizing the contrast between expectation and reality, you can see that slippage and requotes are not rare glitches. They are built-in parts of fast-moving markets. Recognizing this helps you build more realistic stop-loss distances, choose brokers with low latency, and avoid trading right at the edge of news releases. In short, adjusting your mindset to accept that prices can shift a few pips in an instant is the first step toward more reliable risk management. Imagine you're ordering a pizza online and you click the Order Now button, but the kitchen takes a few extra minutes because the internet connection is slow. In Forex trading, that waiting time is called broker latency. Latency is simply the delay between the moment you tell your platform to buy or sell and the moment the broker actually sends that order to the market. Even a half-second delay can matter because currency prices move in tiny steps, called pips, every fraction of a second. If you place a market order to buy euro to US dollar at 1.1000 and your broker's latency is 0.8 seconds, the price might have already moved to 1.1003 by the time the order reaches the market. That 3-pip difference looks small, but on a $10,000 trade, it can change your profit or loss by a few dollars, and over many trades it adds up. Beginners often assume their order will be filled exactly at the price they saw, ignoring this hidden delay. The result is unexpected slippage, where the execution price is worse than expected, and sometimes even a mistrade if the market moves past a stop loss. To avoid this mistake, always check your broker's typical latency, which many platforms display as average execution time, or ping. Choose a broker with servers close to the liquidity providers you trade, and consider using a virtual private server if you need faster connections. A practical takeaway: before you start live trading, place a small test order during a calm market period. Note the time it takes to fill and compare the fill price to the price you saw. If the difference is larger than a pip, you know latency is affecting you, and you can either adjust your strategy or switch to a faster broker. Remember, speed matters in a market that moves every millisecond. A stop loss is like a safety net you place on a ladder to catch you if you slip. In Forex, it is an order that automatically closes your trade when the price moves against you by a certain amount, protecting you from larger losses. Beginners often set their stop-loss levels unrealistically tight, meaning they place the stop only a few pips away from the entry price. For example, you might buy pound sterling to Japanese yen at 150.00 and set a stop-loss at 149.98, just 2 pips below. That sounds safe because you are limiting loss to a tiny amount, but the market rarely moves in a straight line. Even normal price noise, the tiny up and down wiggles that happen every second, can push the price past your stop. In a real-world scenario, a sudden news release or a fast-moving trader can cause the price to dip to 149.95 within the same minute, instantly hitting your stop and closing the trade before the market has a chance to move back in your favor. The result is a series of small, frequent losses that erode your account and your confidence. The underlying mistake is treating the stop loss like a perfect fence, ignoring the fact that price can bounce off your level many times. A better approach for beginners is to set stop loss levels based on recent market structure, such as just beyond a visible swing low or high, or using a percentage of your account size, like 1–2% per trade. This gives the trade enough breathing room to survive normal fluctuations. Practical takeaway: after you decide where to enter, look at the last few candles, identify a clear swing point, and place your stop a few pips beyond that point, not directly next to your entry. This simple rule reduces the chance of being stopped out by ordinary market noise while still protecting your capital. Now that we know why slippage matters, let's walk through how to check and adjust the slippage settings in your trading platform, step by step, so you always know what you're signing up for. Step 1. Open your platform and look for the gear icon or the menu labeled Settings. Most platforms place this at the top right corner. Click it, and a window will appear with several tabs. Choose the one that says Trade Settings or Execution. Step 2. Locate the field called Maximum Slippage or Slippage Tolerance. This is where you tell the platform the largest price difference you are willing to accept between the price you see and the price you actually get. For a beginner, a common starting point is 5 pips for most major pairs like Euro to US dollar or Pound Sterling to US dollar. If you see the field set to 0 or unlimited, that means the platform will accept any amount of slippage, which can be risky. Step 3. Adjust the number. Click inside the box, delete the existing value, and type 5 or another number that fits your risk comfort. Some platforms let you choose a drop-down of low, medium, high. Pick medium if you are unsure. Step 4. Make sure the toggle labeled Enable Slippage Control or Apply Slippage Settings is turned on. It usually looks like a small switch that should be green. Step 5. Save your changes by clicking Apply or OK at the bottom of the window. Finally, test the setting. Place a tiny market order on a low volatility pair during a quiet time of day and watch the execution price. If the filled price stays within your 5 pip limit, you have set it correctly. If it jumps beyond, you may need to lower your limit or consider a broker with faster execution. Practical takeaway: always set a maximum slippage that you can tolerate and verify it with a small test trade before you commit larger capital. This simple habit protects you from surprise price gaps and keeps your risk management plan intact. All right, looters, imagine you're at a grocery store. You pick up a loaf of bread that costs $2, but just as you're about to pay, the price tag changes to $2.20. In Forex, that sudden price change is called a requote. A requote happens when the price you saw when you clicked buy or sell is no longer available because the market moved faster than your broker could execute the trade. It's most common during fast news releases or when a broker server is a little slow. Here's how you handle it, step by step, so you never panic. Step 1. Stay calm and don't immediately click the first button you see. Step 2. Read the new price shown in the requote window. Compare it to the price you expected. If the new price is still within your acceptable range, you can click Accept New Price to let the trade go through at that level. If it's too far away, click Cancel and wait a few seconds for the market to settle before trying again. Step 3. Check the spread, which is the difference between the buying and selling price. A wider spread often triggers requotes, so you might want to switch to a broker with tighter spreads or trade during less volatile times. Step 4. Adjust your stop loss and take profit levels to reflect the new entry price. Otherwise, you could end up with a stop that's too close and gets hit immediately. Finally, keep a log of each requote event. Note the currency pair, time, and why it happened. Over time, you'll see patterns, like certain news events that always cause requotes, and you can plan your trades around them. Remember, a requote is just the market saying, hey, I moved faster than you expected, and with this simple process, you stay in control and avoid costly mistakes. Now that you know what a requote looks like, let's talk about slippage and how to weave it into your risk management plan. Slippage is the difference between the price you expected to get and the price you actually receive when your order finally fills. Think of it like ordering a pizza for delivery at 6 p.m., but the driver gets stuck in traffic and arrives at 6:10 p.m. You still get the pizza, but it's 10 minutes later than you wanted. In trading, those extra minutes can mean a few pips, tiny price units, lost or gained. For beginners, ignoring slippage can turn a well-planned trade into a surprise loss. Here's a simple way to protect yourself. First, decide on a maximum slippage you're willing to accept, often expressed in pips. For Euro to US dollar trade, you might set a max slippage of 3 pips. Next, adjust your stop loss by adding that slippage buffer. If your original stop loss was at 1.2080 and you allow 3 pips of slippage, move the stop loss down to 1.2077. This way, even if the market jumps 3 pips past your entry before your order fills, you're still protected. Second, choose order types that limit slippage. A market order guarantees execution, but can suffer slippage, while a limit order sets the exact price you're willing to accept, though it might not fill at all. Many platforms let you set a maximum slippage parameter for market orders. Use it. Third, monitor broker latency, which is the time it takes for your order to travel to the broker's server. Lower latency means less chance of slippage. You can test this by placing a small trade during a calm market and noting the difference between the quoted price and the filled price. Finally, record slippage in your trade journal. Write down the expected entry, the actual filled price, and the slippage amount. Over weeks, you'll see an average slippage figure that you can feed back into your risk calculations. By treating slippage as a regular part of your risk plan, just like position size or stop-loss distance, you keep your potential loss within the limits you set, even when the market moves quickly. Let's bring everything together with a real-world case study on pound sterling to Japanese yen, a pair that loves to jump during UK economic news. Imagine it's 8:30 a.m. London time, and the Bank of England releases a surprise interest rate cut. Within seconds, the price rockets down from 152.30 to 152.10, a 20-pip move. You have a short trade idea. You want to sell at the top of the move, around 152.28, and set a stop-loss a few pips above your entry to protect against a quick reversal. In the first scenario, you ignore slippage. You place a market order at 152.28 and set a stop-loss at 152.20, assuming a tight 8-pip distance. Because the market is moving so fast, your order actually fills at 152.31, 3 pips worse than expected. The price then continues down to 152.10 before bouncing back. Your stop-loss gets hit at 152.20, but because you entered at 152.31, you lose 20 pips instead of the 8 you planned. That's a 250% larger loss than you anticipated. In the second scenario, you incorporate slippage control. Before the trade, you decide to allow a maximum slippage of 3 pips and adjust your stop-loss accordingly, moving it down to 152.17. You also enable a max slippage setting in your platform, so the order will only execute if the price is within 3 pips of 152.28. The order fills at 152.30, only 2 pips worse, and the stop-loss sits at 152.17, giving the market a little more room before it triggers. When the price drops to 152.10, your trade is still open, and you capture a 20-pip profit. Even after the bounce, you exit at 152.15, netting a solid 15-pip gain. The difference? By planning for slippage, you turn a potential 20-pip loss into a 15-pip profit. The key takeaway is that a small buffer and a max slippage setting can dramatically improve your risk-adjusted returns, especially in volatile news moments. This example shows why every trader, even beginners, should embed slippage awareness into every trade plan. We've reached the finish line of Lesson 11.20, Execution, Slippage, and Requotes. Let's pull everything together so you walk away with a clear, actionable roadmap. First, remember that slippage is simply the gap between the price you think you're getting and the price you actually receive when your order hits the market. Think of it like ordering a coffee online for $3, but when the barista hands it to you, the price is nudged up to $3.05 because the line moved while you were waiting. Requotes are a bit different. They happen when the broker says, "Hold on, the price just changed. Do you want to accept the new price?" It's like a cashier telling you the total has increased just as you hand over cash. Both phenomena matter because they can turn a well-planned trade into an unexpected loss if you're not prepared. The key takeaways are simple. Always factor a small slippage buffer into your entry and stop-loss calculations, especially during high-impact news. Check your broker's latency settings and choose a broker with fast execution if you trade volatile pairs like euro to US dollar or pound sterling to Japanese yen. Never set stop losses so tight that normal market noise or a tiny slippage would trigger them. Incorporate slippage awareness into your overall risk management plan. Treat it as another cost of doing business, just like spreads or commissions. By doing so, you protect your capital and keep your strategy robust. That is everything for Lesson 11.20, Execution, Slippage, and Requotes. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.